is that gold open interest appears to be resetting downward, which means bullion banks are closing their short positions. They're still at near a record high in short positions, so that does have to clear, though that's on a 10-day lag, so we don't know exactly what the numbers are yet. The last major low in gold happened at 400,000 contracts, and we are down about 100,000 from the top of 540,000. Closing of 100,000 contracts in about 3 weeks and only a $100 effect on the price of gold. That's pretty good news, and it shows that gold has been pretty resilient as open interest has reset lower. Where is the wall of the next financial crisis? Well, we don't know exactly, but I can show you the last repocalypse in 2019 happened when overnight repos took up about 85% of available bank reserves. We are now at about 57%.
In today's episode, Rafi Farber talks about the positive trends in the gold market despite some minor setbacks. He notes that since 2015, gold has been on an upward trend, with the slope of its growth getting steeper over time. This means that the value of gold is climbing faster than before, showing strong market resilience even during periods when the price dips slightly. Farber explains that this is a sign of a healthy uptrend, suggesting that investors remain confident in gold as a stable investment. In terms of market mechanics, Farber highlights a significant movement in the gold market known as the resetting of open interest. This refers to the decrease in the number of open contracts in the market, which generally indicates that bullion banks are closing their short positions. Short positions are basically bets that the price of gold will fall, so closing them could imply that these financial institutions anticipate the price of gold to hold steady or increase. Despite these adjustments, the price of gold has remained relatively stable, which Farber takes as a sign of its enduring strength. Finally, Farber discusses the silver market, specifically the unusual behavior of silver prices in relation to Chinese buying premiums. These premiums have been consistently high and are rising alongside the price of silver, which is a departure from historical patterns where high premiums typically indicated a price low. He suggests this might indicate a sustained demand for silver in China, possibly as an alternative investment to real estate. This change could signal a shift in the dynamics of the silver market, potentially leading to more stable or even increasing prices in the future. Now, we'll show you the best clips of the latest market report with Arcadia Economics, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
There's some big news this week about the CPI, the Consumer Price Index inflation rate, which is pretty fluffy and not very reliable, but it does say something. We should keep in mind that according to this, Atlanta Fed sticky price inflation CPI, which calculates prices that do not change very often, we are still at highs from 1991, 33 years. So it's a 33-year high in sticky price inflation, 4.3%. Yes, we have descended from all-time, not all-time highs, but since 1978, I think, or something like that. So yeah, we've descended here, but we're still at highs not seen in a third of a century. So put things in perspective. And now to gold open interest resetting here. I want to show you one of my patented rectangular charts showing correlations in gold futures between open interest and the price. So in this box, we see here that the gold price has descended from about $24.50, from a high of $24.50 to $2,300. You'd say $150 from $24.50. So that's about 5-6%, something like that. Not much of a move in gold for a move of 100,000 contracts down on open interest. We are at 436,000, 437,000, maybe a little bit lower today as you watch this. Gold did fall a little bit yesterday, which probably means open interest fell further. I would like to see us get back down to 400,000, which cemented a pretty strong bottom back in late February, from which we decided to rocket from about 2,000 to 2450. We could see that again if we descend to 400,000 open interest contracts here, and we're pretty close. So just to show you what happened last time, we fell about 100,000 contracts. We fell here from 500,000 at the beginning of 2024 as the year turned to the end of February. So that took about 2 months. That's it. A fall of 100,000 contracts, and it was only a fall of $100, or 4.7%. So after that, we saw a big move, and we're seeing something similar, about $150. It's around the same percentage, and the same 100,000 contract fall. If we can get down to 400,000, that would be about 140,000 contract fall, and then we should be around a pretty firm bottom. This is a chart that I shared on the Endgame Investor, which you can subscribe to for free on Substack, endgameinvestor.substack.com. And this shows the amount of bank reserves being taken up by repos. Bank reserves is the high-powered money that is at the bank account of the banks at the Fed. And there's a total of about $3.4 trillion available now. We can see here why the repocalypse happened. Going into the repocalypse of 2019, the repo markets were getting more and more flooded, more and more crowded, as more and more hedge funds were accessing the repo market to fund their treasury shorts, which is the same thing that's happening now. There's record amounts of short positions in 5-year treasury notes specifically. I don't know why that security, but I do know that the spread between futures and spot in the 5-year treasury notes, futures, and the bonds is about 76 cents last time I checked. And so that's free money that you can get by selling futures short and buying the bonds themselves. So that's why there's so much short positions in 5-year futures, and those futures positions are being funded by the repo markets. So the same thing's happening now as happened back then. We're not at the extremes because we have higher levels of reserves. But the point is, here at the high here, which caused the repocalypse, 85% of bank reserves were being taken up by the repo market. We're now at 57%. We've been trending higher since 2022. And when we get near 85%, that should be the next repocalypse, where the Fed has to print repos, print money to fund the repo markets, and then print a whole bunch of money besides. The higher we go, the closer we get to that wall, is the general point.
In today's recap, we want to highlight how traditionally high premiums on silver in the Chinese market indicated a trough in prices as buyers took advantage of lower rates to accumulate the metal. However, the current situation deviates from this historical trend. Despite the rising price of silver, premiums remain elevated, suggesting robust and continuous demand. This shift may reflect broader economic or financial shifts within China, possibly due to investors seeking safe haven assets amid uncertainties in other sectors like real estate. As these premiums continue to climb in tandem with silver prices, it points to a deeper, sustained interest in silver as an investment. This could be driven by a perception of silver not only as a safe asset, but also as a hedge against inflation or currency devaluation. The persistent high premiums coupled with rising prices could also indicate supply constraints or anticipations of tighter market conditions ahead. This behavior has broader implications for the global silver market. It could lead to increased volatility as other investors react to signals from one of the world's largest consumer markets for precious metals. If Chinese investors continue to stockpile silver, it might exert upward pressure on global prices, influencing silver markets worldwide and potentially making silver a more attractive investment on the global stage. Understanding these dynamics is crucial for investors and analysts as they gauge the future movements of silver prices and strategize their positions. The Chinese market's deviation from traditional patterns could herald a new phase of behavior in precious metals markets, meriting close observation and possibly reevaluation of long-held market theories. Let's get back into the episode.
Bullion bank shorts near records. So we just did open interest in gold, and this number could be different now. It's on a 10-day lag or something like that, maybe 2 weeks, something between 10 and 14 days. So we do see here that bullion bank shorts are at 226,000, and they've only been higher than that once in 2022. I think this is the March 7th, 2022, our nickel Armageddon, where the entire commodities futures markets across the globe almost crashed when there was a big short squeeze in nickel. But we do see here historically that when we are at these levels in bullion bank shorts, we are typically at highs or local highs in the gold market. It doesn't happen every time, but it did happen these 3 other times. So let's say 75% of the time to reach these levels. So it happened in 2016 at the 2016 high after the end of the bear market. It happened here in mid 2020 leading up to the August 2020 high. And it happened here in 2022 around the nickel short squeeze. So chances are we still need to descend a little bit more. In the gold market, doesn't mean we have to break this uptrend line, but we could get a little bit lower, and then we'll be at a firm bottom once we hit 400,000 contracts in open interest, and these short positions get covered. Chinese premiums. I've showed this chart before. I want to make it a little bit more concise this time. So I rectangled the 3 previous times when Chinese premiums for silver were at these levels, these consistently high levels of about 13%. So there were 3 times, right? Once in 2011 following the silver top, and that here, if you follow the rectangle, is at this low after the second major sell-off after the $50 top. So meaning this premium came at a local silver low. This premium also came at a local silver low at the end of 2014. And so did this one at the 2020 sell-off when silver hit about $11.50 during the COVID lockdown panic. This is different though, because these premiums are rising even as the silver price continues to rise. So this has never happened before. And it means that there is sustained demand in China. Doesn't mean there's not going to be pullbacks. We just saw one a few days ago. But the Chinese are stacking silver. Exactly why? I suspect it has to do with their falling real estate market, and Chinese need places to put money that isn't in real estate, and they're going back to their tradition of stacking gold and silver, because even in China, it was money and still is. A long-term look at silver open interest. So we have here, we see different stages in this market. In the 1970s, it was very obviously clear that the silver derivatives market, that the silver futures market was being used to manipulate the silver price down. You can see here that open interest climbed to all-time record highs that haven't even been close to being replicated since then. So you have here in the 1970s, this is after the 1974 parabolic top here at about 650, I think it was. And then silver didn't do anything until 1979 about, for 4 years. So why didn't it do anything for 4 years? Because, well, everything was being done in the futures market, and that was clearly being done to suppress the silver price, stacking huge amounts of paper silver over the available silver supply. And that ended in 1979, 1980 as these positions were being closed, and silver went into a parabolic top that has still not been replicated since. This is the end of manipulation, right? At least as per the futures market affecting the silver price. And we see here that since then, in 2011, when silver hit $50 again, there wasn't much activity in the paper futures market. There wasn't much activity in open interest here. It wasn't being done there. I think this was mostly an ETF-driven rally. It was an SLV mostly, and it could be that retail traders were just chasing it. But we see here that we have an inverse correlation as open interest gets higher. From 2011 until 2020, the silver price trended lower. So that was sort of like this, but not as much. And now we're seeing a local higher in open interest and a push to silver beyond 30 here. But my point is here that silver open interest is not very much correlated to the silver price. I wouldn't worry that much in terms of long-term trends about silver open interest being high here. No, it probably does need to set down a little bit. I'm going to be following gold open interest, and silver should follow that as it naturally does. The final chart I wanted to show you here is the trending higher in the slope of the trend lines in the gold market since the 2015 bottom. So if you draw a trend line from the 2015 bottom over here, late 2015 at around 1054, and then we had a trend line hit in 2018 at about 1250 something. We're way beyond that trend line now if you extend it out to the present. Then we established a new one at that bottom, which was tagged in 2020, late 2022 at 1610. Right, so that trend line, we're now at a new one with an even higher slope from the 1610 bottom until the September, October 2023 bottom. That's also happened to be when silver hit $16. So that was about 1810, 1820, if I remember correctly, in gold. And now we have a new trend line established from then, which was hit in early 2024. And now we are way beyond that trend line. And notice also that these trend lines keep getting shorter and shorter by the time the trend line slope increases. So the rate of acceleration of the gold price has accelerated. That's what acceleration is. The trend line in the gold market has accelerated since the 2015 bottom, and we keep going higher, faster. It might not feel like it during little pullbacks like this one, but that is the situation.
What do you think of Farber's take? Do you agree with him? Post in the comment section if you're still bullish on gold and silver despite the recent pullbacks, and share your honest price prediction for the end of 2024. Now watch this video right here because it's a perfect fit for you. I see you on the other side.